Welcome, ladies and gentlemen, to this edition of Ausdauer Financial, where we cover all levels of personal finance to help you with your financial literacy. In this week's video, I'd like to cover our mounting national student loan debt. Student loan debt has become second only to mortgages as the highest volume of personal finance debt. They've surpassed credit cards, if you can believe it or not. And they're not far off from passing mortgages, considering student loan debt continues to rise at an exponential rate, especially universities continue to cost more, and more people are driven to schools to get a higher education to make a living for their families and for themselves. Given that, you're looking at not over the past year, but over the life of these student loans, we have 43 million students with active student loan debt, accounting for $1.67 trillion in debt. Most of this comes from federal loans via $1.5 trillion. A small chunk, comparatively speaking, private loans are $119 billion in debt. So, if you have or are struggling with student loan debt, this video is for you. Now, unlike all other forms of debt, this is the only one that you cannot escape from by filing bankruptcy. So, in the course of destroying your credit and screwing vendors and everything else involved in bankruptcy, this stays with you. This doesn't go away. This is stuck to you for life. Well, yeah, because if you pass away, then you no longer owe any debt, but that's not exactly a good way of getting out of debt. Any event, some of the traditional methods that are proposed by the student loan industry on paying back loans include your standard, your graduated, revised pay-as-you-earn, your income-based, your income contingencies. Each of these come with different formulations and different calculations. Fundamentally, they all predominantly suck because they're still going to cost a chunk of change to pay on a monthly basis. The key differences here are the graduated and the standard have different formulas, so they give you different amounts you owe on your amount of debt, but they're done in 10 years, which means they also cost more per month. The other three are based upon federal programs that have been signed by legislation to allow you to pay interest only, which means that as you're paying these monthly fees, you're basically giving the vendors who are carrying your debt free money to say, don't harass me, kind of thing, because you're not paying a dime towards principal. And in some cases, depending on how low you get this number, sure, your $50 a month, your $100 a month will keep student loan vendors at bay, but it won't even cover the interest they're tacking onto your loan every single month. You could go from $100,000 in student loans paying interest only, and at the end of 5 years having a higher balance because the interest that those payments did not cover tacked onto that. Either way, they're going to get their money out of you one way or the other. The key here is, how do we help you get out of debt? And that's what this video is for, okay? Now, if you look on Google, you'll probably see a variety of generic options, such as consolidate your loans, go into income-based repayments until you can stash away money, increase your monthly payments to pay off the principal faster, and refinance your student loans. So let's go ahead and break them down real quickly for you. Consolidation of loans really is only a good idea when you're trying to reduce your interest rates. There's no other value to doing this. Well, there's also the fact that, let me take that back, with no other value to doing this, because if you have like 5 different loan payments and they're on varying levels, then consolidating some of them to reduce the number of monthly payments you make could be helpful to your monthly budget if it makes sense. Again, the primary reason why you would do this would be to reduce your interest rates. Refinancing is also an option solicited by private sector. The reason why I don't like these is because you do not have the luxury of loan forgiveness from the federal government with refinancing with private sector loans. You also do not have the ability to do interest-only payments. When you refinance, you're going into something of a standard or graduated structure. You're paying it off over 10 years, like a regular home mortgage or a car loan or something of that nature, where these private vendors are not interested in giving you any breaks on the monthly payments. They want their money. They're saying, okay, we'll pay off your student or your federal loan program, and we'll convert you into a private loan under our own terms. And as a private sector vendor, I'm trying to make money off of you. I'm not interested in your best interest. I'm interested in selling you money, and that's exactly what I'm doing by allowing you to refinance with us. You see all these introductory rates and promos and everything else because they're trying to suck you in to buying their money, and then they will rape you on interest and various fine writing on their terms and conditions. Okay, I never recommend refinancing because fundamentally, any reason why you might go into doing that, you can accomplish a lot easier in other ways. Simple enough, okay? Now, when attacking your student loans, okay, the increased payments is a natural no-brainer as far as getting rid of debt. Obviously, let's say you're trying to get rid of credit card debt and you owe $50 a month. If you pay $75 a month, you're going to get rid of that principal a lot faster. Same with a car loan, same with anything else you're financing. I get that. Same time, when you're dealing with massive student loan debt, it's already taxing your budget and your ability to make the regular payments as it is. To be able to make more than that, if you're in a position where you have gotten rid of all other forms of debt, okay, including your mortgage, then, well, the mortgage comes down to your personal situation here. If you have a mortgage, let's say under $100,000, and various other factors involved there, that maybe would make more sense to tackle the mortgage first. In other cases, depending on, it really comes down to individual situations there as far as whether you tackle the mortgage first or not, and we'll get into that in a future video. But for purposes of tackling student loans, you want to make sure that you have eliminated absolutely, mortgage aside, all other forms of debt, your car loans, your credit cards, your whatever else you have out there. Anything you're spending money for that is not a daily family necessity, like food, groceries, things of that nature, that you're spending money on that isn't making you money is a debt. And when those are all clear, then attacking increased payments makes sense in that sense. But if you're not there yet, then you're just stretching yourself too thin, and you may not be accomplishing much. Because here's the thing: making a few payments of increased amounts, if you can't follow through with that and attack those with gusto until they're gone, that effort will be more or less a waste to you. Because here's the thing: if you do it for 6 months and then you find you can't do it anymore, the interest over the remainder of your loans will completely wipe out all good that you may have accomplished by trying to make increased payments. It'll go for nothing. It'll be a waste of your time. It'll be all that money you burned on trying to get rid of your student loans. You could have put towards something else that you would actually been able to see tangible benefit out of. Okay? Income-based repayment plans are interest-only and are government forgivable up to 20 years. They are not an ideal situation. However, when you're trying to get rid of debt, okay, you want to make sure that everything other than the one you're focusing on at that moment are as low as humanly possible to free up as much financial resources to go after that one debt or to go after other financial goals you have. Okay? Given that, while IABRs and income-based repayment plans, whatever one is lowest for you, is interest only and doesn't help you get rid of the debt, what it does do is buy you time. And fundamentally, most people, in order to put themselves into a position of attacking their student loans and hitting that as hard as possible, need to transition their other finances to a position to put themselves in a position to succeed with that. given that IBRs help in that case. The other thing they do is it helps keep the student loan vendor at bay. Let's say, for example, you're trying to pay off $5,000 at a chunk. IBRs keep the vendor at bay. Then when you have that money, you can throw it at a semester of payments or whatever it is and eliminate that particular account. Be that as it may. Please let me know if you have any questions, concerns, or comments about attacking student loans. This is a very, very high level overview of student loans, and it doesn't go into all the nuances of each plan. Those would take another video to cover each individual one, and I'd like to know you're interested in covering all these things. So if you please leave your comment section below, I'd greatly appreciate it. I would love to respond to you and give you some feedback on your various situations and what would make sense for you. If you just happen to be coming across this video on YouTube, please hit like and subscribe. It greatly helps the channel. And as always, thank you for watching. Have a wonderful day. I'll talk to you next time.